The September DMAR Market Trends Report was just released, highlighting August data. It's been quite a month. Well, this commentary, I want to start a little bit differently. I want to start it with 3 quotes that really impacted me this month. 2 were actually said this month. 1 was over a decade ago. The first one, let's start out with Realtor.com. They said, despite the crippling and ongoing coronavirus pandemic, millions out of work, a recession, a national reckoning over systemic racism, and a highly contentious presidential election right around the corner, the residential real estate market is staging an astonishing rebound. And we're all feeling that. It's the real estate market that kept people moving forward during the shutdown in March and April, and continues to do so through this long recovery process. The second one is from Lawrence June, and it says if 20% more homes were on the market, we would have 20% more sales, because demand is that high. And you have interest rates with no points below 3%. You have the largest group of millennials, first-time homebuyers, coming into the market right now. And we see continuous year-over-year mortgage purchase applications. In fact, the latest report just came out this week, 28% over last year. That's incredible demand, meaning that many more buyers are filling out mortgage loan applications. They are anxious, they are ready, they want to purchase a home at today's low interest rates. And here's the third one. And this was over a decade ago, and it's one of Steve Jobs' most famous quotes. If you want to make everyone happy, don't be a leader, sell ice cream, right? I mean, this is the chance for mortgage professionals and real estate professionals to be leaders, to help our clients to realize financial freedom and financial stability for the security and safety of their families. This is the ability to not only put a roof over your head, but to build financial stability for generations to come. So real estate provides us that, if we could just get more inventory. So let's dive into some of the numbers coming from DMAR's Market Trends Report. And there's no better place to start than inventory. I mean, that is the topic of the day. The fact that we have all of this pent-up demand from March and April, the generational growth that we see with the 27, 28, and 29-year-olds right now are the largest population by age, and the fact that we have sub-3 interest rates, those buyers want to get in, but the inventory is keeping them out. In fact, 2020, we saw the lowest recorded August end of month inventory with 5,498 homes for sale. Now that number typically goes up from July to August 0.5%. As you would expect, right? Winding down the summer and entering into fall, but that didn't happen this year. We actually saw a drop of more than 14% month over month and a drop of more than 41% year over year. That lack of inventory should push up prices. Now we're seeing multiple bids out on the street, right? Those buyers I know are having to put in either multiple offers to get one, or they're part of a multiple bid on the same home. And so they're struggling to get that home. So I would expect prices to go up substantially, but they didn't. Average and median closed purchase prices both landed under a 1% increase. Now, year over year, quite substantial. We saw the average increase year over year of 11.7%. The median increased 9.18% from last year. The other story that I really am interested in about right now is the attached versus detached, because they both saw a year-over-year increase. Now, the attached saw a slight decrease in prices month over month, but you're also seeing that in the close or the list to close. The list to close for attached was 99.61. Detached, with all those multiple bids, we saw 100.26. So here's a conversation that we should start having with our first-time homebuyers. I know that people are wanting to move away from shared elevators and shared rooftops, but is that the right move for tomorrow, for once we start to head back towards some sort of normalcy? It absolutely makes sense in the middle of a pandemic. But right now, if I'm entering into a multiple bid situation with every home that I'm offering in as I try to go towards the suburbs, I have to think, are there opportunities to improve my budget and or increase my cash flow for investment properties in the attached market. Absolutely something to have a conversation around with those buyers. And we're seeing more first-time home buyers move towards the attached. In fact, they made up over 40% of all of the condo purchases last year. And I expect that number to be even higher this year. What we also saw was the year-to-date increases. So right now, the median close price year-to-date is at 6.19% increase. 30-year average for the the DMAR Market Trends Report area, the 11 counties, is 6%. So we're right there with the average. That's incredible. Last year, remember, we didn't even break 3% for the entire year. So to see 6.19 year-to-date, phenomenal opportunity for those people that own their home. Now on units sold, we're down just shy of 2%. We're down 1.9% from last year. But volume sold, we're up 3% over last year. So we're selling slightly less units, but bigger purchase prices. And we're seeing that as we see the shift towards those higher end single family homes. But both attached and detached were rewarded. So we're seeing detached is up 6.59, attached is up 5.86. So still opportunities for those first time home buyers that are getting outbid and need to turn towards the attached market to start to build wealth through real estate. The other chart that I really get a kick out of in the DMAR Market Trends Report is the alligator. That's the one that's the month-end active listings to the month-end closed homes. Now, we've been flipped for the last several months. We've closed more than we have active inventory, and that's the case for this month as well. We have active inventory of 5,496 homes. We closed 5,959. So we're scooping up as much as we can, as quickly as we can. As long as it comes on, priced right and staged right, that home is getting bought. The last thing that I want to highlight in the DMAR Market Trends Report is the price points. So there's a lot of conversation about people moving into the suburbs, right? They're getting more land, bigger home. And we have something called the wealth effect. So the stock market has seen incredible record highs. I mean, it almost seems like every time we talk about it on the news, it's breaking another record. So with those highs, we see more people getting into the market, especially with things like Robinhood, where they can get fractional shares. And as they're coming in, they're feeling wealthier. And when you feel wealthier, you're willing to spend more on a home. You also have this generational movement of wealth going from the millennials or to the millennials from their parents, the baby boomers. So as that wealth is being transferred, and as people are doing very well in the stock market right now, they're feeling that they can spend more money on those homes. And those single family homes are selling. Those over 500,000 have seen a greater increase than their lower price point counterparts. Now, the opposite is true for the attached. Those price points between 300 and 750 saw the greatest growth in closed homes because those first-time home buyers are turning towards the attached to satisfy demand. So continue to watch that as we roll out and even have those conversations with your buyers looking towards those opportunities. So what's going on in the economy underneath the real estate market? Because it's affecting your buyers and your sellers' psyche, right? Their ability to feel secure in their ability to make a decision, right? So what is going on? Right now, the congressional deadlock on what's happening with the stimulus package is still going. It happened at the beginning of August, and it's now entering into September. And as long as they can't figure out what that stimulus package is going to look like, then those people are going to be resistant to spend. And we saw that. We saw consumer spending ticked up only slightly last month, and consumer confidence was low. It's remained flat, waiting to see what's going to happen. The Fed announced their change. It was a massive change from looking at a 2% target on inflation in the CPI to a 2% average. So what does that mean? So remember when the Federal Reserve was installed way back in 1918, they didn't have a 2% target. But when Bernanke came in, he instilled a 2% target. And so that was an inflation number that we're constantly trying to bring the current inflation down to or up to. We haven't hit 2% for quite a while. But now as we've been under 2%, Powell is saying we're going to allow it to go over 2%, which means that it's going to cost more for consumers every time they go to the store. Now, inflation is the arch enemy of bonds, and it creates an environment where we see interest rates going up. So when that happens, we could see those 30-year mortgage rates go up and steal some of the benefit that those buyers are seeing right now with these historically low interest rates. Remember, they can purchase 10% greater home today than they could a year ago. So although we're seeing the price increases, those first-time home buyers can still get in. But not if we see those rates start to go up. So the last time the Federal Reserve slowed down on their mortgage-backed securities purchases was October 2018. And we did see rates go up, and coincidentally, we saw the stock market drop. And I don't know that it was one for one, but it was perfect timing. So if that happens again, as we see the economy start to strengthen, as we see people go back to work, the demand will go up and we'll see spending increase as consumer confidence increases. All of those increased demand while the supply chain is going to try to catch up because it's been laying dormant trying to figure out how many people are going to buy their product. So until the supply chain fully catches up, there's going to be more demand than supply. We're going to see greater inflation, and we're going to see those mortgage interest rates go up. But for now, Powell is keeping them low, and they're buying enough mortgage-backed securities to do that until they don't. And that's when we're going to start to see the interest rates rise. So this is the perfect time to continue to have those conversations with your buyers, with your sellers, to take advantage of what we know today if they're feeling confident and comfortable in their job situation. Talking about jobs, we continue to see jobless claims hover around 1 million every week. We're expecting the unemployment number to come out later this week, right around 9.9%, slightly better than last month. So when that happens, we're going to continue to see the economy slowly grow stronger. But it's going to be a slow, long recovery. So in the meantime, we have to continue to educate. We have to continue to be advisors and advocates for our clients. They need us now more than ever because home ownership is where you can build stability and long-term wealth. Nicole, Rueth, the Rueth team of Fairway Mortgage, keeping you updated.